Hey everyone, welcome to Macro Regime. Today we're diving into the big picture of investing in the current macroeconomic regime we are in. The global economy is shifting, and understanding these changes can help us make smarter investment choices. We'll cover everything from the US debt crisis to exciting opportunities in emerging markets, commodities, clean tech and more. Buckle up, this is going to be packed with insights. If you're new here, hit that subscribe button and turn on notifications so you don't miss out on future videos. Before we jump in, remember, this is for educational purposes only. I'm not a financial advisor and you should always do your own research or consult a professional before making any investment decisions. Alright, let's kick things off. First, let's talk about the big picture, the US debt situation. As of August 2025, the US has accumulated a staggering amount of debt, with the gross national debt reaching $37 trillion just recently. This massive pileup affects everything from interest rates to currency values. To put it in perspective, the debt held by the public is around $29.6 trillion, and intragovernmental debt adds another $7.3 trillion. It's growing fast, up by about $1.87 trillion in the last month alone. This brings us to the idea of fiscal dominance. Basically, it means that the government's debt levels influence monetary policy. When debt is this high, central banks like the Federal Reserve might keep rates low or even cut them to make it easier for the government to manage those massive debt payments. Right now, in August 2025, Fed Chair Powell has indicated that the Fed may need to cut rates soon, proceeding carefully amid economic uncertainties. And here's the key, since rates are likely to stay low or go lower soon, the US dollar, USD, is expected to stay weak or possibly even decline further. Forecasts for 2025 to 2026 suggest short-term softness for the USD. This weakness can impact investments both domestically and internationally. Think inflation hedges or international diversification. The debt trajectory sounds scary, right? But it opens doors for savvy investors. So, what does this mean for investing? With a weakening US dollar and fiscal pressures in the US, one possible strategy is to look at emerging markets, countries that are developing fast and catching up to more developed economies. These markets often have higher growth potential because they're still building infrastructure, expanding their middle class, and boosting GDP. In 2025, emerging market equities are off to a strong start, surging 10% year-to-date and outperforming developed markets by 6%. Top picks include China, India, Brazil, Turkey, Thailand, and Indonesia. For instance, non-US stocks are outperforming this year, with tactical reasons to buy international equities now. The MSCI Emerging Markets Index is up 8.62% year-to-date, beating the MSCI World Index. But they come with risks, like political instability or currency fluctuations. Still, for long-term growth, ETFs like those tracking Argentina, up 47.82% year-to-date, or China Healthcare, could be winners. Analysts recommend funds like JP Morgan Emerging Markets for exposure. If you're interested, consider diversifying 10 to 20% of your portfolio here. Here's a list of top emerging markets for 2025. India, Vietnam, Mexico, Turkey, and Georgia stand out for investors. Digging a bit deeper, let's focus on regions like Eastern Europe, emerging Europe, and even Spain, which is recovering and offering great opportunities in 2025. Spain's economy is booming, growing thanks to investments like China's planned 11 billion euros influx for 33 new projects. Foreign direct investment, FDI, in Europe is up in southern regions, with Spain leading at a 15% increase in projects. Emerging Europe's 2025 outlook sees 2.7% growth, driven by investment and consumer demand. Countries like Poland are up over 35% in markets this year. Investing here can be attractive due to improving stability and integration into the global economy. Think industrials, energy, and infrastructure. Sovereign credits in emerging Europe look better than developed Europe. For exposure, consider ETFs or funds targeting these regions. Risks? Geopolitical tensions, but the upside is huge. In case of a Russia-Ukraine ceasefire and eventually a peace deal, the entire European market will benefit. Now, let's venture into frontier markets, those less developed but full of promise. Think Middle East countries like the UAE or Saudi Arabia, the Philippines, Vietnam, and other parts of Southeast Asia. In 2025, Vietnam's M&A market is strong in retail, energy, real estate, finance, and tech. Saudi Arabia's Vision 2030 is driving 4.6% GDP growth in non-oil sectors like tech and tourism. UAE FDI is strong in real estate and diversification. Markets like Saudi and UAE are diverging, with property in Bulgaria jumping 18%. These markets have natural resources, young populations, and expanding industries. Funds like HSBC Gift Frontier Markets offer exposure. If you're adventurous, allocate a small portion here. Next up, commodities. Precious metals like gold and silver are classic safe havens, especially with US dollar weakness. Silver is also, beyond a monetary metal, an important input source for solar panels and other industrial usage. In 2025, precious metals crushed other commodities in first half of the year, with gold acting as a hedge amid uncertainties. But beyond that, think rare earth minerals, uranium used for a growing nuclear energy sector, and battery minerals like lithium, cobalt, and nickel. Demand is soaring for tech and energy. Battery metals demand could quadruple by 2040, from 12 M tons in 2025 to 53 M by 2040. Reserves are concentrated: cobalt, copper, lithium, etc. IEA's outlook shows strong investment trends. Miners could unearth riches in 2025 with long-term demand. ETFs or mining stocks are ways in. Speaking of green energy, there's massive potential in clean tech and renewables: solar, wind, hydrogen, and battery storage. In 2025, investment in solar could hit $450 billion, the largest single item. Energy transition investments are tracking high, with battery storage up over 20% to $50B+. Renewables are the fastest growing energy source, up 34%. Solar and wind additions accelerate with cost reductions. Canada ranks 8th in clean tech investment, up 19% to $35 billion. Trends include AI optimization and reshored plants. Investing here means riding the energy transition wave. ETFs in solar or wind companies. Biotech is another exciting area, especially as health tech advances. From new medicines to genetic engineering, biotech firms are solving big problems. In 2025, funding dried up in Q2 after a strong start, with venture capital falling significantly. Global investment projected to grow to $546 billion, but early stage is tight. UK biotech attracted £1.23 billion in first half of the year. Top stocks: Argenex, Ikvia, Beyond Medicines. Volatile, but breakthroughs yield huge returns. Consider diversified funds. Lower rates will most likely give this sector an extra boost. With more devices, EVs, and green pushes, demand for utilities is rising. U.S. electricity consumption will surpass 2024 highs in 2025 to 2026. Global demand up 4% in 2025. Utilities transforming with renewables, fastest growing source. EIA predicts 163 BKW demand. Stable returns amid growth. Look at sector ETFs. Now let's talk about crypto. Volatile but mainstream. Bitcoin and Ethereum as hedges against fiat weakness. As of August 2025, BTC is around $113K, $117K. Market optimistic with ETF demand. Bitcoin have become more mainstream and considered the digital gold and a store of value. ETH is really on fire, hitting $4,700 in August, up plus 80% in just 3 months. Ethereum ETF inflows and regulatory clarity with the proposed Genius Act, which aims to regulate stablecoins, many of which operate on Ethereum's blockchain, has reduced legal ambiguity and encouraged institutional adoption. Bull run possible in H2 2025. Allocate small, 5 to 10% max. Trends: tokenized assets, AI trading. Finally, defense, cybersecurity, and space are booming. Geopolitics drives heavy investments. U.S. defense spending draws investors. Space startups optimistic. DoD budget, $61.2 billion for unmanned systems. European NATO members will increase their defense spending significantly the coming years. Cybersecurity spending over $200 billion by 2028. U.S. industry to $320.86 billion in 2025. Venture funding up 33% to $31 billion in 2024, AI at $12 billion. AI redefines defense, hundreds of billions in spending. growth opportunities in stocks or ETFs. Woo! That was a lot. From US debt to space tech, the 2025 landscape is full of shifts and opportunities. Diversify, stay informed, and manage risks. What do you think? Bullish on emerging markets or crypto? Drop a comment below. Like, share, and subscribe for more. Thanks for watching. See you next time.